Welcome to the deep dive. Our mission today, it's pretty laser focused. We are diving into one of the, most valuable, but honestly also one of the trickiest tax breaks out there for entrepreneurs, for freelancers.
That's right. We're talking about the self-employed health insurance deduction.
Exactly. And if you're a business owner, maybe juggling 1099s, trying to figure out how you can claw back some of those, frankly, skyrocketing insurance costs, you're definitely looking for a clear path through what can feel like a maze of IRS rules.
Oh, absolutely. And this isn't just, small potatoes. It's really high-stakes knowledge we're talking about. The critical thing right off the bat is that this deduction, it's what they call an above-the-line adjustment to income.
Okay, above the line, what does that mean practically?
It means it lowers your adjusted gross income, your AGI, directly on your main tax form, the 1040 or 1040 SR. So you get the maximum punch from it before you even think about standard versus itemized deductions.
That AGI reduction, yeah, that's kind of the holy grail in tax planning, isn't it?
It really is. But, and this is a big but, the rules for who qualifies, how you calculate it, they're dense. And there are these eligibility traps that, they require real precision to avoid.
Okay, let's unpack this then. Before we even get tangled up in the forms and the math, what's the absolute core eligibility? Who exactly does the IRS count as self-employed for this specific deduction?
Right. So the main financial gate you have to pass through is this. You absolutely must have a net profit for the year, a profit from the specific business that actually established the health plan.
Net profit, got it.
Okay.
Does it go beyond just the typical sole proprietor, the freelancer?
Yes, definitely. It includes general partners in a partnership. It can include limited partners too, but specifically those who get guaranteed payments. And importantly, it also covers S corporation shareholders.
Oh, interesting. Any S corp shareholder?
Well, specifically those who own more than 2% of the stock and received wages from that S corp. So yeah, it covers quite a few different business structures, not just the classic solo act.
Okay, so that defines who might be eligible. Now, on the flip side, what kind of insurance premiums can you actually count towards this deduction? Is it just strictly major medical or?
No, thankfully it's broader than that, which is good news. It definitely includes your standard medical insurance.
Okay.
But also dental and vision insurance premiums count. And crucially, it also includes qualified long-term care insurance premiums.
Long-term care too, yeah.
Yeah, though just a quick note, those LTC premiums have their own separate deduction limits based on your age, which, is a whole other deep dive maybe.
Right, understood. So you've got medical, dental, vision, LTC. Who can actually be covered by the policy for those premiums to count towards your deduction?
It's the usual suspects, mostly. So yourself, obviously, your spouse, any dependents you claim.
Standard stuff.
Standard stuff. But here's an expansion that's, highly relevant for a lot of families today. It also covers your children who were under age 27 at the end of the tax year.
That's big.
Yeah, and this applies regardless of whether you can actually claim them as a dependent on your tax return.
Okay, so carrying that recent college grad on your plan, even if they're earning their own money and aren't your dependent anymore, those premiums might still count for your deduction.
Potentially, yes, up to age 27. That rule is vital, as you said.
Okay. Now, let's say you've got the right person, the right insurance type. Are there limits on the deduction amount itself, like regardless of how high your premiums actually were?
Yes, there are two really critical non-negotiable limits. Think of them as guardrails.
Okay, what's the first one?
First, the insurance plan itself has to be formally established under your trade or business. It can't just be, a random personal policy you bought. It needs that business connection.
Established under the business. Got it. And the second limit?
The second one ties back to that profit we mentioned. The total deduction you claim for those health insurance premiums cannot be more than your earned income from that specific trade or business.
Okay. So, quick example.
Yeah.
If my business netted, say, $30,000 profit, but I paid $40,000 in eligible health insurance premiums.
Then your deduction is capped at $30,000. You can't deduct more than the income that business generated, even if your premiums were higher. The profit is the ceiling.
Okay, that makes sense. That sets the stage for how much you might deduct. But you mentioned traps earlier. We need to talk about the biggest one, the one that really trips people up, especially in households with, say, two incomes. You called it the subsidization trap.
Exactly. This is probably the most dangerous hurdle, the one that disqualifies people most often without them even realizing it sometimes.
So what instantly kills the deduction?
It's an absolute rule, and here's the kicker. It applies month by month. You simply cannot deduct payments for your self-employed health insurance for any single month in which you are eligible to participate in a health plan subsidized by any employer.
Well, wait. Any month you were eligible, not necessarily enrolled, just eligible.
Correct. Eligibility is the key word.
Okay, but hang on. Is there any wiggle room? Like, what if I was eligible for my spouse's subsidized plan through their job, but maybe the cost to add me was astronomical? So I decided, forget that. I'll get my own cheaper plan through my business. Does that matter?
That's the core frustration for so many people, but unfortunately, no. The rule holds firm. Eligibility alone is the decider. It doesn't matter if you actually signed up. It doesn't matter how much it would have cost you. If a subsidized plan was available to you for that month, you lose the self-employed deduction for that same month, period.
Wow, okay, that really underscores how careful, how strategic you need to be when picking health coverage. If you're self-employed, but maybe your spouse has a W-2 job.
Absolutely. It requires planning, sometimes year-round planning based on open enrollment periods.
So when the IRS says any employer offering a subsidized plan can knock out your deduction, who exactly counts as any employer? Just my own potential W-2 job.
No. The scope is much wider, unfortunately. It includes your own employer if you happen to have another job with W-2 income, your spouse's employer, which is the really common one,
Right.
but also an employer of one of your dependents.
Even a dependent's job.
Yes. And critically, looping back to that under 27 rule, it also includes an employer of your child who is under age 27, even if they're not your dependent.
Good grief. So if my 25-year-old non-dependent kid could get subsidized insurance through their job, I could lose my self-employed deduction for the months they were eligible.
For the months you are also eligible to participate in any subsidized plan, yes, it's about your eligibility, triggered by any of those employer relationships offering a subsidized option. It's broad.
Okay, that is quite a net they cast there.
Yeah.
And just to tie up the long-term care part, does that same harsh eligibility rule apply to deducting LTC premiums too?
Precisely, same logic. You can't deduct qualified long-term care premiums for any month where you are eligible to participate in a subsidized LTC plan offered either by your employer or your spouse's employer.
Okay, so hurdle number one is immense. Pass that monthly eligibility test. Assuming you do manage that, which sounds tough enough, let's get into the mechanics. How do you actually figure out the dollar amount to put on your tax return? Do you just, add up the bills?
Well, if you qualify and your situation is fairly straightforward, the IRS gives you a default path. It's the Self-Employed Health Insurance Deduction Worksheet. You'll find it right in the main instructions for Form 1040.
The standard worksheet in the 1040 instructions. All right.
Yeah, that handles the majority of cases, the simpler scenarios.
But knowing the IRS, there are always exceptions, right? When does someone who is self-employed have to ditch that standard worksheet and use something more specific, maybe a dedicated form?
You're right. Complexity breeds exceptions. The standard worksheet just isn't built for certain situations. You absolutely must bypass it and use a different calculation method if, number one, you had more than one source of income that's subject to self-employment tax, like 2 different businesses maybe.
Okay, multiple SE income streams. What else?
Second, if you file Form 2555, that's the form for foreign earned income exclusion. If that's part of your tax picture, no worksheet for you.
Foreign income, right. And the third?
The third trigger is if you are using amounts paid for that qualified long-term care insurance we mentioned to figure out your deduction. Because of those separate age-based limits on LTC, that calculation needs its own dedicated space. It can't just run through the simple worksheet.
Got it. So multiple businesses, foreign income, or using LTC premiums for the deduction, any of those mean the standard worksheet is out. It sounds like the IRS is basically saying, look, if your situation has these extra layers, we need a more detailed tracking form.
Yeah.
So what is that dedicated form you have to use instead?
If you hit any of those exceptions, you must use Form 7206 instead. It's specifically titled Self-Employed Health Deduction. It's designed precisely to handle those more complex allocation and limitation issues that the worksheet can't.
Form 7206. Okay. Good to know. But what about people getting insurance through the ACA marketplace? That seems like a common scenario for self-employed folks.
Ah, yes, excellent point. There's a specific nuance there, too. If your plan was obtained through the health insurance marketplace, healthcare.gov, or a state exchange, and you are also claiming the premium tax credit, the PTC.
Which many people do to lower costs.
Exactly. If you're claiming the PTC, then you don't use the Form 1040 worksheet or Form 7206 for this purpose. Instead, you have to use a different IRS publication. Publication 974, which is all about the premium tax credit.
Pub 974. Why the different route?
It's basically to ensure that the premium tax credit, which is a subsidy itself, and the self-employed health insurance deduction don't improperly overlap or let you double dip on the benefit for the same premium dollars. Pub 974 integrates those calculations correctly.
Okay, that makes sense. Coordination is key there. And one quick heads up, just to be complete, there's an exclusion related to retirement funds, right?
Yes, just a quick one to remember. Do not include any amounts you paid for health insurance coverage if those payments were made using tax-free distributions from a retirement plan. This comes up sometimes, particularly for retired public safety officers. That money already got a tax break, so you can't deduct the premiums paid with it.
Right. No double dipping allowed.
Okay.
Now let's dive into something you hinted at earlier that sounds like it causes real headaches, covering that non-dependent child who's under age 27. You said it gets tricky, especially if your business income cap means you can't deduct 100% of the premiums.
Yes, it really does create what I call an allocation puzzle. The first part is simple enough, filing-wise. The premiums you pay for that non-dependent child's coverage, they get claimed right there on Form 1040 or 1040 SR, just like your own premiums, aiming for that valuable AGI or reduction first.
Okay, so they go into the main deduction calculation initially?
Correct. But the critical distinction, the tricky part, comes up if you have excess premiums. Meaning, the total premiums paid are higher than what you're allowed to deduct on Form 1040 as that above-the-line adjustment, maybe because of that business income limit we discussed.
Right, the deduction is capped.
Exactly. So if you have leftover premium amounts that weren't deductible on Form 1040, you need to look closely. If any portion of that excess premium amount is specifically attributable to covering that non-dependent child, then that specific portion cannot be claimed anywhere else. It can't be carried over to Schedule A with your other itemized medical expenses. It's just lost as a deduction permanently.
Ouch. Okay, so some of the premium might just vanish tax-wise. That means we absolutely have to figure out how much of the total premium cost is attributable to that non-dependent child, right? To know what we might still be able to deduct on Schedule A versus what's lost.
Precisely. You need to allocate. And the rule for how to do that allocation hinges entirely on one question. Did adding that non-dependent child actually increase your total premium cost?
Okay. So, scenario one, maybe I already had family coverage, say for myself and my spouse. Then my 25-year-old kid comes onto the plan, but the total family premium stays exactly the same.
In that case, because the child didn't cause a cost increase, the IRS says no complex allocation is necessary for this specific rule. Any excess premium you couldn't deduct on Form 1040 can potentially flow to Schedule A, subject to the usual medical expense limits.
Okay, that's the simpler path. But what about the other scenario? Let's say the premiums did increase. Maybe I had self-only coverage. Then I switched to a family plan specifically to add my 26-year-old non-dependent child.
Right. If switching coverage or adding the child did cause your premium to go up, then you must perform an allocation. The rule is you have to treat the amount you are deducting on Form 10410-104-SR as being attributable to the non-dependent child first, up to the amount of the premium increase they caused. Let's use the IRS examples to make this concrete.
Yeah, examples help. Okay, example one from the IRS guidance.
Okay. In example one, let's say you're self-employed. You had self-only coverage costing $5,000 a year. Then you switched to family coverage that costs $10,000 a year. And the only reason for the switch was to add your 26-year-old non-dependent child.
So adding the child caused a clear $5,000 increase in the premium, $10,000 minus $5,000.
Exactly. Now, let's say after you run the numbers through the worksheet or Form 7206, you find out your business income limit allows you to deduct only $4,000 on Form 1040 as that above-the-line adjustment.
Okay, paid $10,000 total, but can only deduct $4,000 on page 1 of the 1040.
Right. Now comes the allocation. Since the $4,000 you are deducting on Form 1040 is less than the $5,000 premium increase directly caused by adding the child, the IRS says that entire $4,000 deduction is considered allocable to the non-dependent child.
Okay, so the forte deduction is used up covering the child's portion first. What happens to the rest of the premium?
Well, remember, the original $5,000 premium, that was just for your self-only coverage. That part, the $5,000 specifically allocable to you, can now potentially be included with your other medical expenses on Schedule A, subject to the 7.5% AGI threshold, of course.
Okay, so $5,000 might go to Schedule A, but wait, the total premium was $10,000?
Yeah.
We deducted $4,000 on Form 1040, and $5,000 went to Schedule A. That leaves $1,000 unaccounted for.
Exactly. That remaining $1,000. That's the excess premium amount. $10,000 total, $4,000 deducted, $5,000 to Schedule A. That is deemed allocable to the non-dependent child because the total $5 increase wasn't fully covered elsewhere. And that $1,000 is permanently excluded. You cannot claim it anywhere.
Wow. Okay, so that one detail, did adding the child physically increase the premium payment? Makes a huge difference in whether any leftover premium gets lost or can potentially be itemized.
A massive difference. It determines what happens to those excess amounts.
Okay, let's quickly look at example 2 then, the contrasting case where there was no cost increase.
Right. Example 2. Same total family premium, $10,000, and you're covering your 26-year-old non-dependent child. But in this scenario, you already had the $10,000 family plan before you added the child. Maybe you had it for yourself and a spouse already. And adding the child didn't change the $10,000 cost.
Okay, so the child coming onto the existing family plan didn't bump the price.
Correct. Now, same situation as before. Let's say your Form 1040 deduction is limited to $4,000 due to your business income.
Paid $10, deducting $4K on Form 1040. What happens to the remaining $6,000 this time?
Because the child did not cause a premium increase, there's no specific excess amount that is deemed attributable only to them that needs to be permanently kicked out. Therefore, the entire remaining $6,000, $10,000 total premium, $4,000 deducted on 1040, can be included with your other medical expenses on Schedule A.
Ah. So in this case, the full $6,000 potentially counts towards the itemized medical deduction, still subject to the 7.5% AGI floor, but at least it's not just lost like the $1,000 in the first example.
Exactly. It's a night and day difference based purely on that allocation rule triggered by whether the premium increase. It's incredibly specific.
Okay, that is a crucial detail for anyone covering older, non-dependent kids. So, stepping back now. After we've figured out if we qualify month to month, figured out which calculation path to use the standard worksheet Form 7206 or maybe Pub 974, and wrestled with any of these tricky allocation rules. Let's summarize. Where do these costs finally land on the actual tax return?
Right. Let's bring it home. There are essentially two places these health insurance premium costs can end up giving you a tax benefit. First, and this is the main prize, the deduction is taken as an adjustment to income directly on Schedule 1 of Form 1040 or 1040 SR.
That's the above-the-line part, reducing your AGI, the primary goal.
That's the primary goal, yes. It's the most valuable spot for it. Second, if you itemize deductions on Schedule A and you couldn't claim 100% of your premiums above the line on Form 1040 because of the income cap, for instance, then you can potentially include the remaining premium amounts with your other medical expenses down on Schedule A.
Potentially include.
Potentially, yes, with two big caveats we've discussed. First, you cannot include any amount that was deemed permanently lost because it was excess premium attributable to a non-dependent child who caused a price increase.
Got it. Exclude that lost portion.
And second, all medical expenses on Schedule A, including these leftover premiums, are only deductible to the extent they exceed 7.5% of your adjusted gross income. So that 7.5% floor makes this Schedule A deduction far less certain and generally less valuable than the direct AGI reduction on Form 1040.
Okay, so the path is aim for the Form 1040 deduction first. Maximize that based on income. Then, if you itemize and if you have leftover premiums and they aren't the excluded non-dependent child type, then they can go on to Schedule A, but only count if your total medical exceeds that 7.5% hurdle.
That's the flow. And you can see why the IRS provides those very specific pathways. The worksheets, Form 7206, Pub 974. It depends heavily on your income sources, how you got the insurance, who's covered. The complexity really highlights why checking that monthly eligibility is so foundational.
Absolutely. Look, the self-employed health insurance deduction, it's genuinely one of the most significant financial advantages a small business owner or freelancer can get. It directly reduces your taxable income. But as we've just spent time unpacking, navigating the rules, especially avoiding that subsidization trap month by month, knowing which calculation form or publication applies to you, and really understanding this non-dependent child allocation piece, that's the absolute difference between successfully claiming a valuable deduction and, well, making a costly mistake or leaving money on the table.
It truly is. Precision matters here.
So let's connect this to the bigger picture, leave you with something to think about. Given this really strict rule about subsidized plan eligibility, not just for you, but potentially triggered by your spouse, your dependents, even your kids under 27 working somewhere else, how might knowing these detailed tax implications actually influence your family's overall financial strategy?
That's a great point.
For instance, when your spouse's open enrollment comes around, maybe the decision isn't just about finding the plan with the absolute lowest premium for the family. Maybe you need to factor in Would enrolling in that specific subsidized plan potentially wipe out a much larger self-employed health insurance deduction for the other spouse? How might calculating the total household tax benefit change the conversation about which employer plan makes the most sense? Or maybe even whether one spouse should take the employer coverage at all?
Yeah, that shifts the perspective from just premiums to total after-tax cost, considering the loss deduction.
Exactly. It turns a simple insurance choice into a more complex strategic family finance decision. Something definitely worth pondering as you navigate the world of self-employment and taxes.